Good evening. Defying increased pressure from the government and North Block boss P. Chidambaram in particular, the Reserve Bank of India left interest rates on hold yet again in its monetary policy review today. The central bank, however, cut the cash reserve ratio for banks by another 25 basis points. While the decision to leave the policy repo rate unchanged at 8% was in line with forecasts and economist surveys, expectations for a rate cut had grown after the finance minister had outlined a plan to trim the country's hefty fiscal deficit just yesterday. The Reserve Bank governor, on his part, has indicated that there might be some easing in rates in the near future. Writing in the quarterly policy review, Diviri Subbarao said, and I quote now, "There will be an opportunity for monetary policy to act in conjunction with fiscal and other measures to mitigate the growth risks and take the economy to a sustained higher growth trajectory," unquote. A cut in interest rates has been pending since April, and the clamour by companies and investors for monetary easing has been getting louder every month. The demand for a rate cut has been bolstered by recent statements made by the finance minister. P. Chidambaram on Monday outlined a plan to nearly halve the deficit in just over 4 years. While the blueprint for deficit reduction was short on specifics, it's clear that North Block sees this as the right time for the RBI to move on interest rates. Ladies and gentlemen, tonight on The Big Picture, we will discuss the RBI's decision to hold rates, its indications that a cut is in the pipeline, and we will also review the finance minister's ambitious plan to halve the deficit by 2017. My panel tonight includes Dr. Santosh Mehrotra, DG IAMR, also Renu, Kohli, former member of the IMF and the RBI. In just a moment, we'll be joined by Rajesh Mahaptra, Deputy Editor of Hindustan Times. And with me in the studio right now is Professor Pinaki Chakraborty of the NIPFP. I'd like to start with you, Professor Chakraborty. Quite along expected lines, this CRR cut of 25 basis points, interest rates kept on hold. Don't you think, even as North Block piles on the pressure, the feeling within the RBI hasn't really changed from last year? They feel it's not the right time for a rate cut, and Governor Subbarao will stick to his stand come what may.
Yeah, it looks like that, but in my view, the fiscal consolidation plan that was unveiled yesterday is basically the Fiscal Committee plan. And RBI also has projected the fiscal deficit, which this RBI says that it will be around 5.8. And the finance ministry says 5.3. So 5.8 is pretty close to what the Fiscal Committee said, about 6.1. So RBI probably thinks that fiscal deficit level is still high, and inflation is definitely at a level which they feel is uncomfortable. And that is the reason why, despite this fiscal consolidation plan proposed by the finance minister, they have not really changed the policy rate. But having said that, I would also like to say that one has to understand that we have a new normal inflation rate now. So this new normal inflation rate will have to be recognized by RBI. Now, if we think that in the next 2-3 months our inflation rate will come down to 4 or 5%, that's not going to happen. But in the process, if we keep our interest rate very high for a sustained period of time, I think we are going to kill growth.
Right. Point taken, sir. That's an important point, and I'm sure my other guests will want to add to that. But Dr. Mehrotra, I want to come to you now. I want to talk about the fiscal consolidation roadmap that the finance minister has outlined in just a bit. But before we get to that, Dr. Mehrotra, a section of the media, especially business papers now, they have been speculating whether the finance minister is sort of miffed with the RBI for delaying a rate cut. There is a time for saying something and there is a time for silence. P. Chidambaram is reportedly he's told journalists today. Are there tensions between North Block and Mint Street?
You mean North Block and the RBI?
Yes.
Well, it seems so. The honest answer has to be that it does seem so, because the message was coming not just from the finance minister but also from the Prime Minister a few weeks ago. Because I've made this point on your program earlier, that at this point of time, there are not that many arrows in the quiver of the government of India, conceived of as the RBI on the one hand and the Finance Ministry on the other. And monetary policy could have been done with a flick of a switch, while fiscal consolidation is going to take time. It is as Pinaki and Mr. Kelkar have rightly said, it's a roadmap, and the process has begun. So I'm miffed as well, I'm sorry to say.
Right. I think you're echoing North Block's views, of course. We'll get to you, Dr. Mehrotra, in just a moment. I want to get Renu Kohli in on the discussion now. Renu, there is, though, however, an indication from the RBI side that it will move on interest rates sometime in the near future, perhaps Jan, Feb, perhaps March. No one really knows. But conservative estimates put the rate cut at about Jan to Feb. Now, is this just accommodating the clamour for a rate cut that the RBI is going to do, or even if it does cut rates in Jan-Feb, will it be purely and just because the RBI is satisfied that this is the right time for a cut?
No, I think it's not just accommodation. It is definitely a forward guidance that the central bank is giving. And in its view, as it sees, it has raised its inflation forecast at end March 2013 to 7.5% from the 7% earlier in July. So I am a bit surprised that it sees room for an interest rate cut towards the fourth quarter of 2012-13. But it does expect inflation to come down a bit from the current levels, and that's what its forward guidance is based on.
Right. Professor Chakraborty, Dr. Mehrotra just said it, even he is miffed with the RBI right now. You mentioned before the program that you don't know what the RBI is doing. Do you think that indicating that they might just cut rates in Jan-Feb is enough? Don't you think because, not just because the government is pressurizing them or giving statements saying that this is the right time for a cut, don't you think that this is actually the right time for a cut and they've been delaying it for too long now?
I think the right time has gone. Probably we should have cut rates 6 to 7 months before. As I said, that inflationary expectation is high, but it has also been coming down, and we have to understand the fact that the 7 and 7.09 or whatever that the most precise and accurate estimate of RBI will have to be understood in the context of new normal inflation rate, because some of these issues have been discussed in the policy circle, and it has been understood well that some inflationary issues in India or globally, if we look at, are very structural in nature now, and some of these are primarily due to the supply shocks like the high crude prices and things like that. So unless that comes down, if you continue your investment cost higher, that means keeping the interest rate continuously at a high level, given high fiscal deficit, you definitely would create problem both for the private as well as for the public sector.
Right. I've been told that Rajesh Mahaptra, Deputy Executive Editor of the Hindustan Times, has just joined us. Welcome to the show, Rajesh. Your first thoughts on the CRR cut today? RBI hasn't touched interest rates. It's kept them steady even now. My guests seem to think, Dr. Mehrotra just mentioned that not just North Block, but also he's miffed with the RBI. Your thoughts on the policy review today?
It came as a surprise. Surprise not because of any understanding of the fundamentals that might be panning out, but because there was so much of expectations, and also given what the kind of views that have been coming across from North Block and the series of actions that have been promised to come from the finance minister in terms of curtailing fiscal deficit, which the RBI had had stated in the past as one of the stumbling blocks or one of the key factors that was holding it back from a rate cut. But at the same time, what one is worried about, which is the Reserve Bank of India still looks at the downside risk that inflation poses as heightened as it was a couple of quarters ago. And if one sort of reads between the lines, it doesn't look like up until the Governor unveiled today's policy review, that the RBI was in a mood or is in a mood to go for a rate cut at least for the next 2 quarters.
Right. Rajesh, I want to get Dr. Mehrotra in for a quick comment before we go to a break. Dr. Mehrotra, the question, of course, posed by many experts, economists, what have you, is what is really needed for India. Now, India needs low inflation. We all agree to that. All my panelists would agree to that now. But even though the RBI has been saying that inflation is their primary target, if somehow inflation is not addressed, no amount of rate cut is going to address inflation. Would you agree with that at least or not?
Sorry, repeat your question. I think I didn't hear that very well.
What I meant was experts have been saying that what is really needed for India, is a rate cut going to solve our problems or not? Even if inflation is not kept very low, no amount of rate cuts will actually help get inflation down or revive the economy.
Well, at this point, what would help inflation, reducing inflation, would be strengthening of the rupee. And if a rate cut was to happen, it would make equity more attractive relative to debt, and it would attract more FII inflows into India. Capital inflows would lead to an appreciation of the rupee, and the appreciation of the rupee would cut import costs, which would have a downward impact on inflation. So a rate cut would have impacted on inflation through strengthening of the rupee. So there was an inflation target which could have been met by cutting the interest rate. I mean, we all know, Pinaki said, I've been saying repeatedly, everyone knows that this is cost push inflation. It is not demand pull inflation. And whatever impact inflation, whatever impact rate, high rates could have had on inflation have already been realized. I can't see how it can go on any further.
Right. Dr. Mehrotra,
yes.
We'll take a small break right now. We'll come to Renu, Kohli and Rajesh after the break. I want to talk about, after the break, the fiscal consolidation plan that was outlined by the finance minister just yesterday. That and more after the break. Don't go anywhere. Keep watching The Big Picture. Welcome back to The Big Picture. Now, coming to Renu, Kohli now. Renu, let's talk about the fiscal consolidation plan that was outlined by the finance minister, P. Chidambaram, yesterday. It's short on specifics, say critics of the plan, but he plans to halve the deficit by 2017. Ambitious, very ambitious, say some, but some also say it is entirely possible if the finance minister brings his A game. What would you say?
Can you repeat the last bit again? Brings in?
His A game, in the sense that if he does carry out everything that he's promised, then it's entirely possible that 2017 will see us having a deficit of 3%.
Okay. I agree with the critics that the fiscal consolidation plan is as yet just a roadmap. It's a path, and it just gives specific indicators that the deficit reduction will be X% next year and Y% the year thereafter, and by 2017 it will be halved. Beyond that, what are the measures and how that reduction will be brought about? It is totally silent upon that. On the other hand, throughout in the last 1 month, we've heard very clearly that the poor shall be protected, and I go along with that and I agree with that. But having said that, let us see, where it remains to be seen as to where the reduction in the deficit is going to come from. Whether it shall come from the revenue side, that is expansion in the tax base or higher tax collections, which are then contingent upon a growth revival in themselves, or on the expenditure reduction side. The three main items of expenditure are on current expenditure side are actually transfers and interest payments. So there is a serious problem there. There isn't much scope other than wages and salaries. There isn't much scope for expenditure reduction. Unfortunately, interest payments have to be honored, and so the only scope for reduction is in rationalizing subsidies, and on that it's quite clear the finance minister has quite candidly said that subsidies, including the proposed food security bill, etc., shall be honored. I mean, shall go ahead as designated or planned. So I do think that there is an enormous amount of uncertainty about implementation in this consolidation path, which is not to say that it cannot be done. The second route towards consolidation would be through sale of assets, disinvestment. Now that is very critically dependent upon the state of markets and realization from both auctions as well as disinvestments.
Right.
Currently, even that, the prognosis on that is not so good in the near term.
Right. So it's interesting you brought up the sale, the stake sales and the divestment of PSUs. We'll talk about that in a bit. But before I ask you the same question, Rajesh, on this investment, I want to ask you the fiscal consolidation plan that's been outlined by the finance minister. You heard what Renu just said. He said that subsidies, of course, will be honored. Do you think it's a highly ambitious target? Cutting the deficit into half by 2017. Can the finance minister do it?
Athar, I think Renu has spelt it out quite lucidly. I think very comprehensively. I would go with all of that. It is still a roadmap, and we are yet to see as to how this roadmap will be realized. Unless there are efforts to increase revenue, I think the pressure on expenditure will continue to be there. Do not forget that we are also going into an election in 2014, where political imperatives would always take precedence over fiscal prudence, if it comes to that. I am therefore not, I won't say whether, I think it would be wrong to sort of view these targets as ambitious or over-ambitious targets, because you need to set targets. But I think if you are talking in terms of whether they are realistic, we would have to see as to what is the game plan on the revenue front, because that would hold the key. I think the pressure on spending would be there, more so when we are going into elections. Now the election season has already begun. We will be seeing elections in 3 critical states next year, and probably if the Lok Sabha elections are to be held as per the schedule, then by middle of 2014 we have the national election. So it will be very difficult to expect that the government would be doing anything substantive on the spending front.
Right, Rajesh. I want to come to Pinaki Chakraborty now and ask him this. The Finance Minister, Pinaki, expects to realize the budgeted receipts under disinvestment and non-tax receipts. Now, the government has set a target of garnering around 30,000 crore from different stake sales in PSUs, in public sector undertakings such as Hindustan Copper, Bharat Heavy Electricals Limited, MNTC, etc., etc. It also expects to receive about 40,000 crore from the auction of second generation of telecom spectrum. What else does the Finance Minister need to do to execute the plan to get us to 3% of fiscal deficit?
See, these are all one-time payments. Like if you talk about disinvestment proceeds, or if you talk about spectrum sales.
Spectrum is a windfall game.
These are all windfall. Even disinvestment, for that matter, is a windfall. If you get it, if you don't get it, of course, your situation is different. So I don't think we can really rely on them as our permanent source of receipts and expect that our finances will remain at a stable path, sustainable path in the long run. So if you really want to have a fiscal consolidation, as per your FRBM Act, you need to realize more revenues. And if you look at India's story of fiscal consolidation, which everybody talks about from 2003-4 to 2007-8, it was primarily the revenue driven. It is the revenue which has grown at a very fast rate that brought down your deficit. Now, if we really want our fiscal consolidation to happen in the next 3-4 years, I don't think these things will be the solution for that. I think we need to increase our revenue in a sustained basis. And one more thing that I'll add on the expenditure side, see, much of the subsidy that we are talking about, there has been a quantum jump. Subsidy in 2007-8 was 1.37% of GDP. Now it is 2.35. Now this increase of almost a percentage point, is primarily due to the increase in petroleum subsidies. And that is because the crude oil prices have gone up.
Right.
So this is something which is extraneous shock to the fiscal system. So if we really have to control our subsidies apart from food, petroleum subsidies will have to be controlled. And if you have to control petroleum subsidy, you need to rationalize prices. You need to rationalize taxation on petroleum. So if these specific changes come in, if not 3, at least we can bring our deficit at least to around 4% in the next 2 to 3 years.
Right. Dr. Mehrotra, I want to ask you this, since banks are making a sweet buck even now, they are earning sizable profits, some of them at least are making sizable profits, do you think there is room to get the banks to cut rates? Would that be a prudent idea?
Let me address that in a minute. I think there are several issues that have been raised. It's very important that Pinaki emphasized that revenues were rising over the period 2003 to 2007-8. Well, a very important reason why revenues were rising and hence fiscal consolidation happened was because growth was very high. So we need to focus a little bit more on growth than we have been so far, and the RBI is not helping. This is the point I'm re-emphasizing.
Right.
And I want to underline the point that a rate cut at this point would have made many infrastructure projects profitable at the margin. At the margin is very important because, of course, there are many factors which are holding back investment in infrastructure. But a rate cut would have helped many projects and speeded them along. And public investment too is on its way. So in other words, we've got to get growth back.
Right. Point taken,
and secondly, I'm sorry, let me just finish. And I would like to re-emphasize the point I was making about the need for cutting interest rate in order to invite more capital inflows, because it would strengthen the rupee. And as Pinaki just said, you know, a very significant reason why the share of subsidies has risen is because of fuel subsidies. Now if you want to cut the fuel subsidies, one of the ways is to strengthen the rupee. So rate cut would have helped in that. So can we get our logic right, please?
Right.
I mean, if you read the RBI press note, it's so mealy-mouthed, it's unbelievable. On the one hand, on the other hand, it has no clarity of vision at all.
Right. Point taken, sir. Point taken. The RBI needs to get its act together, according to you, and a lot more others in the government. But my question to you stays, Dr. Mehrotra, since banks are making a sizable profit, some of them at least, do you think there is room to get the banks to cut rates?
Well, the banks, if you listen to the press conference earlier today, the bank GMs were all saying, well, we've got a problem because we've got to restructure the loans of big companies, and the Reserve Bank has already put a limit on that. So I don't know to what extent they have the ability to cut rates. You listen to several of the private sector banks, ICICI, HDFC, etc., and they said, well, further down the road they might. But today they don't feel, I mean, but we need it today. This is precisely the point.
Right. I want to go to Rajesh Mahaptra for a quick comment, and I'll come to Renu and we'll end the program with Pinaki. Rajesh, you heard what Dr. Mehrotra had to say. He said emphasis on growth should be highest priority right now. He gave the example of 2003, 2007. Revenues were high. Why? Because growth was good. Growth was having a ball then. Do you agree with Dr. Mehrotra there that the RBI, the time to act has passed now? It's past that stage when we should have cut interest rates.
It looks like the RBI is trying to replay or rather play to the script that it did in 2007, and when it paid off, and therefore, you could say that, look, at that point in time, we were the ones who remained hawkish and it paid off. And there is no harm doing that again, and probably, they think, I'm getting a sense that this is the wisdom that is guiding. But the situation that we are in, just as you speak about the need for bold moves, I think somewhere along the line you will have to take some risks. And that risk could be, even for the central banker today, that you go for a rate cut.
Right. Renu, Kohli, your thoughts on what Dr. Mehrotra just said. Do you think the RBI needs to understand that growth should be highest priority? Do you think they're following the script, like Rajesh said, and they're hoping for a replication of what happened in 2007?
Oh, Mr. Mehrotra has rightly said that growth was high and therefore revenues were high. But he has forgotten or omitted one very important macroeconomic variable. Between 2003 and 7, inflation was also low. So if you put that in, then we get the maths right, the macro maths right. So that's my take on interest rates.
Right.
Certainly with inflation high, the central bank cannot abandon its price stability objective at all. Second, he is suggesting a strategy of lower interest rates in order to attract capital flows. I thought capital inflows were attracted by a combination of higher interest rates and appreciating currency, but never mind that. But the strategy would be very unwise to follow rupee appreciation along with lower interest rates, primarily because we've got a huge current account deficit. So the rupee has to be kept weak in order to reflect the fundamentals A and B in order for the current account gap to close.
Right. Dr. Mehrotra, I'd like you to respond to that very briefly,
to keep
please.
Inflation and to attract capital. So I do not agree with both of the things that he suggested.
Right. Very briefly, Dr. Mehrotra, very briefly if you want to respond to that. Very briefly.
Well, it's rather difficult to respond to that briefly for this.
We are running out of time, sir.
Absolutely. I think we've got to focus our attention much more on growth, and cutting rates makes infrastructure projects profitable at the margin. That's a very important part of the argument.
Right. Dr. Mehrotra, I'd like to close the show by coming to Pinaki Chakraborty for the last word. Trajectory of interest rates. How do you see it in the medium term now? Where do we go from here?
It depends what RBI does and what happens to inflation. As RBI, if RBI's sole objective is inflation targeting and inflation remains at 7 and 7.5, I don't think that it's going to come down very drastically in the next 6 or 7 months. But the point which I was making in the beginning is the point of new normal inflation. You cannot compare 2003-4 to 2007-8 inflation with the inflation that you have now. Macroeconomic situation worldwide also was very different than what it is now.
Right.
You didn't have a global financial crisis, you didn't have a Eurozone crisis, you didn't have lower export demand. So there are combinations of factors which actually led to this situation. In such a situation, if you think only objective of a central bank of developing country like ours is only inflation targeting, then we really are going for a difficult days to come.
On that note, sir, we'll have to wind up. I must thank all my guests who joined me for the Big Picture today. Renu, Kohli, thank you so much for joining us on the Big Picture. Dr. Santosh Mehrotra as well. Rajesh Mahaptra, thank you so much as usual, as well as Pinaki Chakraborty, who's in the studio with me. That's all we have on the Big Picture tonight. Till next time, Athar Khan saying goodbye, good night, and thank you for watching.